You might have heard the saying "it pays dividends." This expression refers to an action taken now that can pay some reward or benefit in the future. In the world of stocks, sometimes it actually does in the form of, well, a dividend. So what are dividends, and more importantly, what do they mean for investors? Are they really just free money from generous companies? Dividends are regular payments of a company's profits to shareholders. They're sort of like rewards for putting your money into their venture, similar to the way you'd receive interest for money in a savings account or a bond. Let's take a look at how dividends work and their pros and cons. My name is Chris and I help teach people about money, personal finance and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Most often companies pay out dividends in cash, but they can also give additional stock to their shareholders instead. Why would a company do that? For one, it's a way of rewarding their investors for putting their trust and cash in the company. Companies that have extra money have two options. They can either pay shareholders in the form of dividends, or they can reinvest that money into their business. Typically, the board of directors will distribute dividends if they can't get a high return on investment by using that cash to grow the company. If they can't use it to grow, they might as well give a portion back to shareholders. Older and more stable companies are more likely to pay dividends as their growth has slowed, while new companies are more likely to keep investing in the company. But dividends also tend to have a positive effect on an investor's outlook. It can give them more confidence and keep them satisfied even when the stock price isn't rising in value. Dividends are seen as a sign of stability and financial health. If an investor is consistently getting paid good dividends from a company, they're likely going to be a pretty loyal shareholder and happy receiving regular income. How does a dividend work? Say you buy 10 shares in a company and they announce a $1 dividend per share for this quarter. So you get a 10 dividend payment. If they do this for each quarter throughout the year, you'll end up with a total dividend of 40 for that year. Dividend yields won't make you rich. So on average, companies pay 1 to 2% of their stock's price in dividends annually, with 75% of those in the S&P 500 index paying regular dividends. Some companies also offer dividend reinvestment programs called DRIPs. These let you reinvest the cash dividend back into the company's stock, often at a discount. And of course, if the company pays the dividend in new shares of stock instead of cash, it just means you own a little more of that company. Dividend reinvestment can usually be done with most brokerage accounts too. The dividend that's issued will be used to purchase more shares at the most current price if you don't decide on cash payments. The company's board of directors makes the call on how the company pays its dividends and how frequently they're paid out: monthly, quarterly, which is most common in the US, or annually. The board also has to get shareholder approval on the distribution of the dividends through a vote. Types of dividends. On top of getting bonus money, a lot of people like dividends because they can come with some tax advantages. But these advantages depend on the type of dividend you're dealing with: qualified or unqualified. Qualified: if you've owned the stock for more than 60 days before the ex-dividend date, or the day that determines your eligibility to receive the dividend, and the dividend was paid by a company or qualified foreign corporation. That dividend is qualified. Qualified dividends get better tax rates because they're actually taxed at long-term capital gains rates rather than income tax rates. Unqualified, also known as ordinary dividends. These dividends are unqualified because you didn't own the stock for more than 60 days before the ex-date. These dividends are taxed at your regular income tax rate. Dividends from other sources. Dividends don't only come from single stocks. Other investments and even some insurance companies also pay dividends. For example, many index funds and ETFs pay dividends. Although you only own a fraction of shares, you'll receive payments accordingly. In the case of index funds and ETFs, the dividend is based on the fund's net asset value, or NAV calculation. Simply put, that's assets minus debts. If your shares in the fund earned a profit, the fund company can choose to use that money to reinvest in the company, pay down debt, or give you a cut of the profit in the form of a dividend. Buying a fund provides the stability and diversification of owning multiple companies, which is favorable to a dividend investing strategy. There are seemingly endless options, including dividend growth funds. High dividend funds are just a broad market fund that pays an average dividend. You can design your ETF or index fund allocation to align perfectly with your needs by purchasing a fund that provides the right amount of appreciation and income. Bonds are another type of investment that can pay dividends. When you buy a bond, you're lending money to a company or government entity. In exchange for your loan, the company or government agrees to pay you a fixed rate of interest, also known as a dividend. Unlike stock dividends, bond dividends are a legal obligation. But it's not recommended you bet your retirement on bonds. You're better off investing your money in a mix of growth stocks that provide a better balance of risk and reward. Another vehicle that might pay a dividend is a surprising one: life insurance. Some insurance companies are called mutual insurance companies because they're not publicly traded and the policyholders own the company mutually. If the company makes a profit, they can declare a policyholder dividend. But remember, life insurance is not an investment. It's just insurance. How do dividends affect stock prices? Once the news of a dividend payment becomes public, you can see a rush to purchase a stock before the ex-date. Investors tend to flood into the company even though the dividend payments are ordinarily quite small. In this case, you'll see the share price go up. Another thing you'll often see is the price going down after the ex-date because anyone buying the stock on or after that date won't receive the dividend. So people sell the stock. This doesn't make complete sense because if a stock has a 2% annual dividend yield, it only pays 0.5% on a quarterly basis. That could easily be consumed by daily market fluctuations. Most investors focused on dividends aren't concerned with these small price fluctuations. Should you invest in something for the dividend? Don't be fooled. While dividends might feel like a bonus or reward, it doesn't make sense to invest in something just for the dividends because usually the dividend payments end up in slower capital appreciation. More often than not, those companies have slower growth, so the overall returns aren't necessarily going to be higher. Secondly, just because a stock pays a dividend doesn't mean that's a good thing. In the past, General Motors took on debt specifically to fund their dividends. To put it simply, this is basically the shareholders taking out a loan to pay themselves. As a result, GM underperformed the market while oblivious shareholders stayed invested in. Lost money. As a rule of thumb, think of each percentage of the stock's price that's paid as a dividend. The stock's capital appreciation will be that much less. Well-known dividend stocks like Target, Johnson & Johnson, Coca-Cola, and Procter & Gamble have a long history of stable dividend payments and reasonable capital appreciation. However, since these companies have been around for a long time, the overall returns don't compare to newer fast-growing companies that reserve their profits for reinvestment within their business. Earning dividends can be advantageous to your investing strategy. The income received on a regular basis can be used to fund retirement expenses or to buy a new car depending on your situation. They could also provide low tax income. But that income received is in a way just withdrawing from your portfolio. You want to be careful when owning companies for the dividends in particular, and make sure it's in good financial health and not solely paying the dividends to please shareholders. Take a look at the entire picture instead of only buying for a high yield. Often stocks with exceptionally high yields are in some sort of trouble which won't end well in the long term.